Hello and welcome to Talking Stocks. I'm Gugulethu Cele. Also in studio, I'm joined by Peter Armitage and Sean Ashton, both from Anchor Capital. Now, they are the experts, and together we bring you insightful analysis into JSE-listed companies. This week, we look at one of the largest mining companies in the world, Kumba Iron Ore. Now, this is quite a humding of a company, especially given the fact that it's part of the Anglo-American family, but has quite a few assets under its belt as well. Sean?
Sure, it's a big business. I mean, they've got three key assets. I think the first one is Sishen Iron Ore, which produces 35 million tons worth of iron ore every year. That's a lot of rock that they're pulling out of the ground. There's a secondary asset called Kolomela, which is about 11 million tons, and then what you can call a legacy mine, Tabazimbi, which is 1 million tons per annum. So there's about 48 million tons per annum worth of production that's of iron ore. Of which most is shipped overseas. So there's only about 10 or 11% consumption in South Africa, but the vast majority is sent to global markets like India and China.
So if there's great demand from across the border internationally, how does Kumba Iron Ore compare on an international scale against its peers?
So I think it's a large business, but I think the more important point to understand is that their production profile has actually lagged that of a lot of the bigger global peers in Australia. And that's where that's where the real concern is from an iron ore perspective, is that you've had significant production growth out of Australia in terms of BHP Billiton's mines and Rio's mines, and they're a lot further down the cost curve than what Kumba Iron Ore is. So I would say in terms of global competitiveness, Kumba is slipping.
A lot of the exports, as you mentioned, are going outside of the country and only 11% domestically. Peter, a lot of this is obviously dependent then on global sentiment, and in the environment that we're in at the moment, we know things aren't looking too positive.
Yeah, absolutely. I think what we're seeing is what happens in commodity markets, and I think one of the points we want to make in the show is the word commodity means something. It means it is a complete commodity. It's a piece of iron ore, a lump, or whatever form they export it in. And you can't sell yours for more than anybody else's. You can't create a brand. And ultimately, it's simply a function of what supply is in the world and what demand is. And going back to 2004 to 2007 or 8, when markets were flying, a huge amount of new capacity was put in. And you're seeing a lot of that flow through now. So supply is growing at a healthy pace, and there's new mines coming on stream at pretty low costs. And demand is growing, but demand is not growing as fast as supply is growing. And hence you've seen the iron ore price plummet. Exactly.
Tell us about that price, Sean, because a moment ago we just had that graph on screen. It will come up again. Sure. We've seen a significant decline in that iron ore price.
Yeah, so I mean that's the only product that they sell, right? So it's important to look at it. In 2013, the average price was $135 a ton. That dropped to $97 a ton as of 2014, the average for their financial year. So obviously a significant reduction. But when we look forward to where we are now, you're sitting at $62 as the spot price. So there's more profit erosion to come in the year ahead, and I think that's important to understand.
Well, we did speak to the CEO recently when the company did publish its results. Norman Mbazima, the chief executive of Kumba Iron Ore, had this to say about the impact of the falling commodity price.
The outlook hasn't been great. What we're seeing this year and next year does not give us much hope for a recovery in prices. Supply continues to pour into this market from the Australian majors, and growth is slowing down in the biggest market, which is China. So the outlook does not bode well. However, I think we have taken the decisive actions to reduce capex, to reduce expenditure on projects and on studies and on technical studies and so forth. We have taken action to restructure ourselves. We have talked about a 40% increase in complements at head office and so forth. So we think we've taken the pain to be able to continue to provide some return to our shareholders and to the rest of our stakeholders, our government, our communities, our employees into the future.
Coming back to the issues of the price, Sean, is China still a significant concern, especially given the impact and the role that it plays in the overall global scheme? Absolutely.
So China is the biggest consumer of iron ore. And I think what the recent trends that you've seen is that steel production is obviously the key number to focus on with respect to consumption of iron ore, because that's the key market that iron ore goes into. And what you're seeing is that consumption growth has been growing at about 3% per annum, but that's much slower than seaborne supply of iron ore. So obviously the price is eroding. And in China specifically, consumption, the most recent numbers from a steel perspective in terms of steel production are down about 1% or so. So you're seeing China's growth model is shifting a lot more toward consumption of personal consumption in terms of individuals buying hamburgers and the like, but a lot less building of apartment blocks, which is where you see the real intensity of steel usage. So because there's a shift away from kind of fixed investment towards consumption, your steel intensity of growth in China is falling. So China itself is slowing as well, but the steel intensity is declining, which means less iron ore or slower growth for iron ore demand. If
the demand's not coming from China, Peter, where should we be looking then for Kumba?
Yeah, I mean, the price is a function of global supply and demand. So Europe has been slow, and there's a hope that that'll pick up a little bit. But ultimately, China is probably the biggest driver. America's obviously a big user. China's kind of outsized in terms of the equation. Other than that, it kind of broadly replicates world GDP. So it's a function of Chinese growth and world growth. But ultimately, what it boils down to and comes back to is, if it costs you $50 to lift something out of the ground and deliver it somewhere, there's no fundamental reason why you should be able to get more than $65 or $70 for it. There's different costs. People have different costs around the world. But ultimately, if the new production's coming on stream in the kind of $40 to $60 range, the long-term price should be that plus a reasonable return. The prices of 130 and 140, which people have still got in their heads, and where you saw Kumba trading at over 600 Rand, we think those are long, long gone.
It's a far cry from that. And you mentioned the issue of cost. And Sean, this is clearly a key concern for its Sishen mines, which are aging.
Yeah, I think the key consideration from a Kumba perspective is that it's an old mine. When you look at Sishen, it's a very, very old mine, and we're starting to see that in the cost metrics of this business as a whole. So there's a ratio that they refer to called the stripping ratio, which effectively refers to the amount of waste material that you have to mine out in order to get to the real good stuff. That's obviously the iron ore itself. And that ratio has gone from 1.8 times, in other words, 1.8 tons for every ton of iron ore that you get is waste. It's gone from 1.8 to 4.4 in 5 years effectively, and that number still continues to climb, which basically means that your unit costs are rising well ahead of inflation. I mean, the 5-year average number per annum is about 22% per annum. So your costs are rising a lot faster than you're able to put your prices up, or you can't put your prices up because you're absorbing the global price. And as a result, the margins of this business are shrinking significantly. I think in 2010, Kumba at a group level was making an operating margin of about 65%. Last year it made 40%. It could well make even less than half of that in the year ahead.
Clearly what you're highlighting there is a significant decline that almost seems as though it's going to continue.
It's structural in a way, from the perspective that they're becoming increasingly cost uncompetitive relative to where the big supply growth is happening in Australia, for example.
I'm a little bit worried about this because we've seen overall some of the big mining companies are pulling back from local South African operations and cutting on capex spend. Peter, is that potentially an option for Kumba at all?
Yeah, I mean, they've already announced in their last results that they're trying to cut back on costs, and obviously that's what a responsible and efficient management team does, is tries to cut back on costs and new expansion and capex. But it's often not really a decision. There is a lot of capex. I mean, the capex spend is still big because that's what they're required to spend to get the stuff out the ground. So they'll cut back to the extent that they can, but this business has still got a lot of capex over the next few years. Just to as Sean says, that stripping ratio, you have to put more and more machinery in to get the same amount of iron ore out.
A significant concern here. One obviously worries about the profits, and the dividend also recently took a cut.
And there's more to come there.
Exactly. Yeah. So with this continued nervousness, it almost makes things even more difficult for one to view this investment case.
I think it's very important to focus on the cash flow generating ability of this business into the next couple of reporting cycles. So, the management team alluded to in their prospect statement to say we're in a tough environment. We don't expect prices to recover quickly, and the dividend policy will be less generous in the next dividend cycle than what it's been. So they have guided to that. I think it could be significantly worse than people are expecting, and there's a simple reason for that. If you look at what they earned in 2014, the average price was $97 for iron ore, and the rand dollar was 10.80 odd. Those numbers are now $62 for iron ore and 11.70. That maths results, if you were to assume that those prices remain in for a full year, that maths results in a 30% decline in turnover, And even if they can keep their costs flat in nominal terms, in other words, no inflationary increases in their cost base, your profitability would go from more or less 19 billion rand at the operating level to about 4.5 billion rand. That's just the maths. And then you say to yourself, okay, so that's 4.5 billion rands worth of operating profit. That's after you've charged off depreciation of 2.6 or 3 billion rand. But guess what? Your capex bill is 8 billion rand. So your free cash flows are a lot worse than accounting earnings. And that effectively means that, you know, if those are the metrics, they actually cash flow negative before they even pay a dividend at current prices. So they would have to gear their balance sheet to pay the dividend. So the point I would make is that a lot of investors have looked at this business and the attractiveness of it as a dividend payer. I think that's the wrong focal point now. To me, it's about balance sheet protection almost.
I'm slightly nervous about this one, but we'll get your insights in a moment or two. It's that time that we've been waiting for, where our experts tell us whether to buy, hold or sell this particular stock. Sean, buy, hold, sell when it comes to Kumba Iron Ore?
Sell.
Sell. With immediate effect?
I wouldn't want to own it. I think that there's still better news priced in than what will be the reality. Analysts are looking for 20 rand a share of earnings next year, 13 rands of dividends. I think both numbers will be much lower. The share price has come off a lot, but I think it'll continue to drift lower.
It's down by at least 50% year to date. Peter, do you share Sean's sentiments here?
Yeah, I mean, if I was to choose a portfolio for the next 5 years, Kumba certainly wouldn't be part of it. I think one of the questions you can ask is what is priced into the share? And I think you can well see some bounces. You know, when things come off sharply, if you see iron ore prices tick up, you know, it's a share that can react quite sharply. So for a trader, there might be a little bit of an opportunity. But the way we run our business, we don't think we're clever enough to try and time those things. You know, if it absolutely fell off a cliff some more, we might take a bit of a position. But fundamentally, you know, I think the things are stacked up against the company and the share for over the course of the next few years.
Tough time for Kumba Iron Ore. Well, we'll see how investors continue to react. But that's where we'll leave it for today. Thank you so much to my guests for joining us, Peter Armitage and Sean Ashton of Anchor Capital. That's it for this week. Do catch us again next time where we talk more stocks.